Hello and welcome. My name's David McMillan, Director of Performance Property. Today we're doing a sort of out of cycle update on the Victorian regional towns, primarily because some of the forecasts that we've made in Ballarat and Bendigo haven't exactly gone to plan. There's reason for that I want to share with you today, but also just to discuss the green shoots that are coming out of Victoria at the moment and the positive story that's sort of beginning to emerge from an investor perspective. Before I jump into it, I just wanted to show you a couple of small innovations that we've been making. Most of you will know, if you've been with the business for some time, this is a way that we share with you the client's journey. We start off wanting to build a net asset base, so we start off with growth-focused assets that's largely residential, and then as you mature as an investor and move closer to retirement, you want income from your property portfolio, maybe your broader finance portfolio. At a certain point, a financial planner will be working on this with us, if not already. But these are the key milestones that a client will go through with us, and that's the intent for our business, is we have clients for the long term. Specifically with property, what we like to do is stay sort of hyper-focused on what our objective is with that client interaction. And for most people, still maybe 70% of our database, it's really paying off that principal place of residence, that dream principal place of residence. And then, for a growing percentage of our client base, we are now focused on building out a model portfolio in retirement, 2.5, 5, 10, $20 million, etc. How we sort of bring that to life is we understand your goal first and foremost, and then every 12 months we're going through a property risk review. And then we'll have a 12-month plan that will be reviewed every 12 months ongoing. And that 12-month plan will be, should we buy something this year? Should we sell something this year? With respect to management, are we increasing rents? Are we renovating the property? And sort of in a more extreme case, are we developing a property? So you will be receiving these emails. Would you like to have a review with your advisor? That's what these review meetings are about. And we strongly encourage you to participate in those so we can get to your goal as effectively as possible with the information that we have at the time. When it comes time to buying an asset, this is an innovation. I would say that we've been working on this for 3 years, and most clients would know about it, but some clients still don't. When we think about buying assets now, they go into two baskets: trading, so they're growth assets to be sold in the medium term, or foundation, quality assets to be held long term. Trading assets are primarily engaged with when you're in the I'm still paying off my home phase, and foundation assets are engaged with when you've almost paid off your home phase and you're focused on retirement. Most of our clients are actually engaged in the trading strategy. It's find a market that shows value, buy at the bottom, have reactive maintenance on that property, and then sell it at the next market top. There's a ton of clients in that phase. But as our client base matures, we're moving towards this more model portfolio phase where we could have a combination of growth, balanced, and income strategies or assets. Income is commercial property. Balanced assets are things like unit blocks, and growth assets are still residential houses. But in that foundation asset phase, we're really focused on high quality. If you've got questions about this, just discuss it one-on-one with your advisor. And it's just giving us more clearer frameworks to work with our clients on, so everyone understands what we're doing. Everyone's probably familiar with our property clock. It's evolving all the time, changes every 30 days. Sometimes the changes can be dramatic. Sometimes the changes can be slight. We've made some dramatic changes with Victorian regional towns and also Melbourne. We think it's sort of coming to a bottom, and I'll explain why. The markets that we're squarely on in the moment are those trading markets, those resource-based towns, the mining-based towns, energy towns. We think there's still an incredible opportunity to get into those markets. And again, reach out to your advisor if you want the story. An innovation that we've made in the last couple of years has been the way that we look at markets. So, no longer are we just looking at this clock. We've got sort of a digital view, if you like, and that displays both how much runway we think a market has, and then how in demand that market is. And there's many indicators that give us that demand score. It's a unique statistic to our business, and it measures forward-looking data and also current data. And where you really want to be from a profit perspective is high demand, high growth, and that's all these markets over here, and these markets we've been playing in for some time, and these markets also reflect the clock as well. So it's good to see that they line up, and it's a slightly different methodology that we use to come to these conclusions. We don't just do it for houses, we also do it for units. At the moment, from a trading perspective, there's more growth in units than there is houses. So that's interesting. Historically, we've never bought units, but once we opened up that trading methodology of buying low, selling high, and not wanting to hold that property in the portfolio long term, it's opened up what sort of products we can actually put in front of our clients to achieve their objectives. And again, if you've got questions on that, because it is a slight deviation to what we were saying perhaps 5 years ago, please talk to your advisor one-on-one on that. Now, let's get into Melbourne, Victoria, and explain where we are and why. So with forecasting, it's important to acknowledge that you're always going to be wrong. The question isn't, are you going to be wrong? It's just, how much will you be wrong by? And there's many things that we need to think about when forecasting, wage growth, population movements, supply pipeline, and none of these things are in our control, but we have a certain degree of visibility over a sort of 24, 36-month window, and then after that, it falls away. But usually our calls have been very, very good. I think if you look back at our performance, it's very strong. Most clients have done very well. The Ballarat and Bendigo decision making to go into that market was sound. And then sort of late 2021, 2022, we're still buying, and the growth on those assets hasn't been as strong as what we'd liked, and in some cases they've been flat for a small handful of clients. One of the things that's really hurt our forecasts is the Victorian government and the way in which they've sort of conducted themselves has materialized in a loss of confidence in our market from an investment perspective, to the extent where Victorian-based investors are investing out of state and non-Victorian investors are investing out of state. So the market is running right now on owner-occupiers, and that's it. And so if we just look at why that's the case, it's primarily driven by a lack of confidence in Victoria, and so sentiment is really low. And sentiment is low even though the fundamentals are with the market, which I'll get into in a second. But you think about what's recently happened. Victoria's reintroduced off-plan stamp duty concessions to get the production of new stock going. And if you look back in 2017, they abolished stamp duty concessions. So, they will disincentivize and then re-incentivize. And when we look at property taxes, we just start from 2016. They increased stamp duty on foreigners by 3%. Then they abolished stamp duty. They introduced a vacant residential tax. In 2019, they increased the foreigner stamp duty to 8%. That's on top of the stamp duty they have to pay. New rental laws came into effect in 2021, increasing the holding cost for investors. 2023, the Victorian government announced the withdrawal from hosting the Commonwealth Games due to unexpected cost increases. And a lot of the reason why that's important, because a lot of people lost confidence in the state after that. That was meant to deliver jobs. It was meant to deliver a tourism boost and possibly a population boost. It just didn't happen. And I think the big one that came into effect this year was the increase in land tax. And that was in part to deal with the ballooning debt burden that's now moving towards 175 billion, that is. And so, outside investors are looking at it going, well, the sand's constantly shifting, and the holding costs in Victoria for investment properties are higher than anywhere else. And they're just choosing not to participate in the market. Now, in 2017, 18, 19, these things weren't around. And then from 2020, 2021, 2022, 2023, these things started to emerge, which then obviously changed our forecast. There are also some future taxes on the horizon with regards to property, and all of these things are making it more expensive to produce rental properties, and it's making it more expensive to hold rental properties or investment properties. And the net effect of that is that renters will be affected dramatically, because we're about to see double-digit rents for many, many years in a row. This is the stat where I nearly fell off my chair that shows this is the first year since records began that there are going to be fewer rental properties than there was the year prior. So every year since 1999, every year there's been more rental properties, 5, 10, 20,000 more rental properties coming through to accommodate for population growth. But not in the last 12 months. We've actually lost 21,000. So that means there's been limited stock production of new rental properties, and there's been an exodus from the Victorian market from investors saying, well, this investment case no longer works. The holding costs are too high, so I'm selling, and there's been limited production. And of course, there's been population growth. So we're in this situation now where the only thing that can happen is rents are going to go up, and that's what's going to produce the green shoots for the story for not just Melbourne, but the Victorian regionals as well. So let's just get on to Melbourne, because when you look at the Victorian regionals, they do well when Melbourne's really expensive. They do well once Melbourne kicks. And so the first question for what's going to happen in the Victorian regionals is what's going to happen with Melbourne. And I think it's important to acknowledge that when we go into 2025, we'll probably be going in at a similar level to 2020, and sort of we're looking at a 4 to 5 year correction, which we haven't had a 4 to 5 year correction or a correction this long since 1997. And we really feel that there's a number of things lining up to show that Melbourne is now forming a low, and an opportunity is presenting itself from a buy perspective. When you look at the fundamentals, so does demand exceed supply? Well, the rentals tell us the story. And, you know, in 2020, run rents were 528. Now they're 740. So demand does exceed supply. And what we know, if we go back to this slide, is not only is the rental property production not keeping up with demand, we're actually losing properties from the rental pool to the extent where the rental pool is going backwards. So expect double-digit rents in Melbourne, and probably more broadly Victoria. When I say definitely Melbourne in the next 12 months, and I think we'll have a 3-year run, and then Victoria will follow in patches depending on where. But it's a real positive sign for those that hold property, and it's an opportunity for those thinking about where they're going to go to next. The other thing is Victoria usually spends its time as the second most expensive city to Sydney. That makes sense because it's the second most populated city, which is about to change. I'll go into that in a little bit. But now it's number 7. It's the 7th most expensive city. And with the emergence of rapid growth in Perth, Brisbane, and Adelaide, it's about to become the 10th or the 11th most expensive city in the country. And again, that presents an opportunity for those counter-cyclical investors, which we are. As I touched on, not only will it drop to number 11, but probably at the same time or around the same time, it will become the most populated city in the country. And therefore, in theory, it could be number 1. I think it'd be very hard to get past Sydney with obviously the supply-capped nature of Sydney and the beauty of Sydney, but we definitely shouldn't be number 11. And in 2026, maybe not 2025, but 2026, people will be looking back to Victoria as the value opportunity from a national standpoint. So what you want to do is you want to get your money placed before that happens. So when we look at obviously the future, that's sort of part of the story. But when we look at the future, we have to look at, you know, how many dwellings are required in Victoria, how many dwellings are going to be built. This is in Melbourne, I should say. And then we're going to look at the changing deficiency or surplus. 2026 is a forecast, 2025 is less of a forecast, and 2024 is going to be fairly accurate. Again, because the further you look to the future, the less certain things are for variables that we don't yet understand. But one thing is clear is the vacancy rate is going to continue to drop. And when you have a look at the vacancy rate and the change on rents, you can see that, you know, a 3.9% vacancy rate, rents went up 3%. On a 1.7 vacancy rate, rents went up 14%. On a 1.5% vacancy rate, rents went up 21%. And what we're going to see in the next 12 months and 24 months is a vacancy rate sub 1%, which should see really strong rents plus 15. So we think it'll be 15 at a minimum per annum, but could be much higher, and that will be for multiple years in a row until such time as the dwelling deficiency has been resolved. And there's, other than a small stamp duty concession announcement yesterday, the government is still a shambles, still don't have a plan, and so we're still 3 years off any solution. That's if they can get themselves together in the next 12 months, which, if you look at their history, it's highly unlikely. So the dysfunction that's going on at state government level means that supply won't come into the system, means that rents must go up and renters will be disadvantaged. And for a lot of marginalised people, this is going to be really bad news, and don't want to take away from that. But from an investment standpoint, that's the landscape that you should be looking through and saying, well, what decisions do I need to make to get me closer to my goal, essentially. When we look at Geelong, we repeat the process, and I don't want to go into too much detail, but I think the theme is very consistent, which is the vacancy rate is going to continue to contract, and we are expecting rental growth in Geelong. We are expecting rental growth in Bendigo. We are also expecting rental growth in Ballarat. Right. So whilst these markets probably have gone in a 2 to 3 year holding pattern, largely because of the fact that people have lost confidence in Victoria, and interest rates have had a huge impact, but you kind of had a little bit of a perfect storm where interest rates went up, people have lost confidence in Victoria, Melbourne values have stagnated, so there's no real pressure in the system for values to do anything. But the long-term story for Ballarat, Bendigo and Geelong is really sound. The long-term story for Melbourne is sound. What we really need is interest rates to come off, obviously, which the forecast is we'll get a 100 basis point cut plus in the next 24 months. So you can tick that box. We really need for demand to more dramatically exceed supply, which I believe we presented that case to you today. And then we need rents to take off, and then you'll get this sentiment shift. So for those holding property in Ballarat and Bendigo and thinking, should I sell now, market soft? The answer is you really shouldn't. We had those positions for a reason. We've gone into a temporary holding pattern for things we couldn't see at the time. In hindsight, it's 2020, but these are markets that we're probably going to be increasing our positions in 2025 and 2026, subject to the information that comes through. And if you bought in Bendigo, Ballarat, Geelong or Melbourne for a long-term hold, the case is still sound. Don't do anything, just keep it there. You'll be rewarded. If you bought in Ballarat and Bendigo for more of a medium-term hold with us recently, I think that, we always need to be patient. Things can work out rapidly for us, and sometimes we have a 2, 3, 4, even a 4-year window where the information that comes through doesn't go away and we have to wait patiently. The medium term is always sort of defined by that 5 to 9 year period. And I think those that hold for that duration will be rewarded. There's good news coming. However, I think that the market will probably get a little bit softer in the next 6 months before it then starts to go in the right direction. And I think when we get to 2025 and into 2026, we'll have really strong conditions because there won't be enough real estate to go around. If you have any questions, please direct them to your advisor. Also, a big part of our process is managing your entire portfolio, and we have, because we've been frustrated with the service that we've been receiving in the Victorian regions, we now have property management open in Geelong, Ballarat and Bendigo, and obviously Melbourne. And what we'd like to do is make sure that we're controlling all your assets, including in Brisbane and including in Adelaide and including in Perth, so that we can see the entire picture when we catch up with you every 12 months. And there's new software that we've been working on for the last 12 months, which is going to be released in December, January, and that will enable us to have more pointed, effective conversations when we catch up with the annuals, because we'll be able to see right through what's happening with your portfolio, because the software that we have will connect to Property Me, and we'll be able to see the expenses, and everything will just be more effective for you and more easily managed, and one software program, etc., for your end of year financials. So hopefully that's been informative. there's some good news on the horizon, and we look forward to connecting with you one-on-one soon.